Hi, my name is James Shepard, and in this video series, I'm talking about monetizing payments for software companies. Specifically, we're talking about the application and boarding process here. In the last video, we showed you the technical part of it, how to build out your own boarding API so that you can get people to sign up for their merchant account through your software. In this video, we're going to talk about the mechanics kind of behind the scenes of getting an account approved and what this underwriting process is like. I would say of all the topics I'm going to cover here in this video series, this one is probably the least understood by software companies that I have worked with. They kind of look at this whole payment processing thing and think like, what is wrong with these people? Why are they doing it this way? And I got to be honest with you, you're partly correct. A lot of our industry is doing things they should not be doing anymore. We've talked about the big DocuSign agreements and all these sorts of things that are obviously legacy and should be removed and can be removed from the process today. But there are still a few things that are very important that we need to understand about this ecosystem. So when you accept a payment, all right, it does not mean that you will absolutely be able to keep that money. When somebody walks into my store as a business owner and they hand me a $100 bill and I go deposit it in the bank, guess what? That's my $100. I know it is. I can go spend it tomorrow and I can be totally confident that I got that $100 and it's mine. But when that same customer comes in and uses a credit card and pays me $100, I actually don't know for sure that that money is mine for quite a while. Let me explain what I mean by that. That customer could call back later and say, hey, I didn't get what I thought I was going to get. That product was defective or whatever it is. And they can actually call their bank and they can file something called a chargeback. And the way a chargeback works is that somebody calls their bank and says, hey, I got this charge. I should not have been charged this money. I want my money back. And the bank says, okay. Literally, every time, that's what the bank says. They give them their money back. Where does the money come from? Well, where it comes from is it goes back to the sponsor bank, the bank that accepted the payment, and that bank goes to the business owner. So it goes through the payment processor, which goes to the merchant and says, hey, this customer says that they didn't agree to pay you that $100, so we're going to take that $100 back. But you're welcome to prove to us that it was a legitimate payment. It's a crazy system. But here's what's really interesting about it. There is a whole segment of our industry considered high risk, meaning a segment of our industry where it's very likely that they're going to have a lot of chargebacks. So if you have a little restaurant, local restaurant, I mean, how often is somebody going to call the bank and say, I really didn't agree to that $60 purchase? That's not going to happen very often. But what if you have a travel, a business that does travel, a cruise, right? And what if people are paying for a cruise that they're not going to take for 6 months? And what if you have a no refund policy? Now we have a problem, right? People are paying $3,000, $4,000, $5,000, $6,000 to go on a cruise 6 months from now, and 5 months from now, they realize they can't go on the cruise, and you have a zero refund policy. What are they going to do? They're going to call the bank and say, this is ridiculous. They're stealing my money. And the bank's going to say, okay, here's your $6,000 back. They're going to go back to the merchant and say, give us the $6,000. And the merchant's going to say, wait a second, that was a totally legitimate transaction. There's a zero refund policy, but now it's going to be on the merchant to prove that they should have got the money. Now, why am I telling you all this as a software company? The reason I'm telling you all this is that this creates a scenario of risk. Overall, when you look at the big picture, it's not that much risk, big picture, but it's big risk individually. In other words, it is totally possible for a software company to accept a bunch of payments on behalf of a bunch of merchants and then to have a big problem where those merchants all go out of business or something, and then the payment processor gets stuck losing $500,000 or something. That has happened many times. So as a result, when you try to set up merchant accounts, there is an approval underwriting process where the bank that's involved wants to make sure that the merchant accounts you're setting up are legitimate. They want to make sure people aren't fraudulently setting up an account to process payments from stolen credit cards, right? And then keep the money while people are reaching out to their cardholder, the bank, and saying, hey, I didn't agree to that purchase, and now I have a big mess, right? So understand that that does exist. Now, here's the way you kind of avoid it or skirt around it as a software company while still protecting yourself in this situation. The way you do it is with a targeted underwriting process. Most likely, if you're watching this video and you're a software company, you probably are going after one specific vertical or type of business, right? You probably are serving like in my case, self-storage property owners, or you're serving attorneys, or you're serving hair salons, or whatever it is. So your software most likely is serving a specific vertical, and that's great because if you work with the right company, they can automate the underwriting process to fit that criteria. And they'll say, okay, we're gonna, when that merchant submits their application with their social security number, their EIN number, their address, all this stuff, then the payment processing company, their underwriting department, they can set up software and automation to just check and make sure that the person that's applying really is an attorney if you service attorneys, and that, their average transaction they're saying is going to be less than $5,000, and, whatever these criteria are, they can validate those automatically in a matter of seconds. And then they can automatically approve the account based on the fact that they fit the general criteria. They're going to be able to do that probably 95% of the time, depending on if you have a good vertical that's low risk and just regular businesses. They can usually automate a big chunk of that process for you and be able to instantly approve the vast majority. But don't be surprised when they say, hey, wait a second, we can't approve that account. We need to see a bank statement, or we need to see proof of ownership, or whatever it is, because there is a real financial risk in signing up a fraudulent merchant account, and they need to make sure they mitigate that risk. In addition to that, sometimes they're going to automatically approve an account, but then as they go through further manual due diligence, they will come up with a red flag and say, wait a second, we approved this account, but when we actually crawled their website, we found that they do something totally different that doesn't fit this criteria. We need some more information. Otherwise, we're going to have to cancel that merchant account that we previously approved. So I wanted you to understand that piece of it because it's very important as we go into the payback model, which I'm going to get to in the next video, to understand how underwriting risk and all of that works in our industry. But let's dive into the payback model and all of that in the next video.